This conference will now be recorded.
Hi, hello. Thank you so much for tuning in to view our brief video on specific topics that are relevant to pre and post retirees. About this particular one is focused on one topic primarily, and that's about taxation and how important it is to have an advisor as well as a plan, but to have an advisor that also is equally versed and credentialed in tax planning and tax advice. The reason is because you have to prepare the stage before you retire, and after you retire, the money taking it out is a whole lot more complicated, as you will see, and I'll show you in our brief workshop today. So thanks again for joining us. My name is Jeff Serino. For those of you who don't know, I'm the founder of Alpha Planning and Financial. We have two locations. Our headquarters is in Solon on Concord Road, and we have another one in Independence in the New York Life Building. Glad to join you. I'll get right to it. But for those of you who don't know me, I'll give you the really short version of my story. Is that my earliest beginnings, I'm a financial planner now, but when I was as early as 6 years old, I hated money. I was actually afraid of it. It was because I came from a medium-sized family at the time, but money was always a problem in our house. And my parents were notoriously both equally not the best. And there was basically kind of some financial illiteracy. Now, I'm the youngest of four boys, and two of us managed to rewrite our programs and continually educate ourselves and not keep keep repeating the same mistakes that our parents and others have made that we see or saw. And two of our brothers weren't so lucky. In fact, bad financial decisions really very greatly contributed to much of their early sad demise. And to stay on a positive note, or to get to a positive note, I just want you to know that I've learned to love to help to teach people, and that's what our clients say, and we like to explain things all in a way that people can understand. So we have a short time here to keep your attention, and I'm going to get going. So why would you want to watch this video? It's because it contains critical information. And this information is based on facts. It's not opinion or any baseless or anything like that. And this is specifically for people about 5 years or so from retirement or already in retirement. So that's a big range of people, but it's a very special time of life for many reasons. And there's a lot of things that are different. And that's why people do go out and educate themselves in person or on videos such as this. So what we're going to do by watching this video, by the time we're done with this video, you're going to see exactly how to prepare yourself for the upcoming tax freight train that's coming. And it's going to be hitting every retiree's IRA significantly. And I will go into that about our tax rates. So hang in there. It's a tax rollback that's actually going on. So we're going to stay focused strictly on converting converting Roth to regular IRAs. What are the differences? What's an RMD? Because they work into the fact about Roth conversions, and I'll go through all that. So we'll have a very focused, laser focused session here. So I'm going to take myself off the picture here for a moment, and I am the author of several books, and I do have a book offer at the very end of this for a free book, and everyone will have an opportunity to get that. Certainly, we've been going through a lot of bad news. There's been no shortage of it. A lot of money was lost, at least temporarily, in the markets and things like that. But something you can always control is your tax planning. And the thing is the reason is because a lot of people do not have to approach tax planning until they, hit 50, 55 or above, and they start to see that taking money out is a lot harder and more complicated than just putting the money in and working for the majority of our lives. So that's the difference. And the other thing is that the financial industry, by and large, is geared strictly towards brokerage, keeping money in the markets, in their accounts, and discouraging withdrawals. So since we're a fiduciary firm, we do a plan. We put the process before products or portfolio recommendations, just so that you have an idea where we're coming from on this. Will coronavirus affect your retirement? Well, there's just a few changes regarding COVID before I go into but these affect IRAs. So these are changes that have just come into play within the last 60 days. And first one is, if you don't know what an RMD is yet, you will. But for those of you that do know what it is, there are no RMDs in 2020 for traditional IRAs, which would also include 401ks if you're not working, and also beneficiary IRAs. Those are that's when someone inherits an IRA from someone other than a spouse. It could be from a parent, it could be from a sibling, I mean, it could even be a friend. It doesn't even have to be a relative. Okay, so no RMDs, but of course, if people need the money to meet their annual budget, that doesn't change anything. They've also waived for this year the 10% 59.5 penalty if you do need to make withdrawals for survival. We do have ways constructively that have always been in place to help people if they do have all IRA, 401k money, stuff like that, and they retire before 59.5. There is a way that we have done for many people that is in the IRS rules that avoid that penalty in any phase, but it's very specific and all that, and there's lots of stuff that would have to be explained. But they're temporarily waiving that 10% penalty. The other thing is that they've increased loans on 401ks, which if you're borrowing on your 401k and you're approaching retirement, you are not going in the right direction unless you're trying to just clean it up and not ever do that again. So, so I've never met anyone that was a successful retiree, because I've been doing this 26 years. I've never met someone who was well off when they were ready to go, when they had a bunch of credit card debt or they had loans on their 401ks. It's a very tricky thing. Just giving people more access doesn't mean that anything to as far as your accumulation abilities. So just keep that in mind. So here we go. I told you that the tax train is a-coming, and that's going to mean that these rates that we all have had, which are the lowest, by the way, folks, you can look it up. These are the lowest tax rates in anybody that's living today's history. And you may not know it or not because you're not thinking in terms of taxes and stuff, but in retirement, you kind of have to. Things change, it's more complicated. You don't want to burn through your money, and that's the real reason here, so that you keep more of your money, and taxes are something that you can really control ahead of time, because we do tax planning rather than just, we don't do specific tax preparation. We have a CPA that does that. So, but this is what we're doing, the higher level planning, which is really the long-term stuff, which just saves people the most amount of money, not just, hit a little deduction here or that bracket here. So, but all of these rates go back on January 1st, 2026 to where they were automatically. There doesn't need to be any act of Congress whatsoever for that to happen. So that's a very big likelihood that it will automatically sunset. And there's much thought about, will they even raise taxes even more because of all, especially now because of all the pandemic giveaways and things that they've had to do to try to stimulate the economy. So these are the old rules are on the left and the new rules are on the right. And you can see that there are more brackets and there are lower brackets on the right side. So in other words, we're living in the 2020 realm here on the right, but 2026, we go right back to the other rules where there was larger brackets and less of them as well. This is the same thing, but for married filing jointly. And you can see the same thing, higher on the left, currently lower on the right. When you talk about, when you talk about tax brackets, what we were just looking at is represented in this way. When you look at this, you can see, if you understand our tax system, it's based upon it's called a graduated tax system, where when you fill up pretend your income is water for the year, anything that's taxable is water, say, and you're filling up to your 12%, and you have a little bit more water that some of it pours into the 22%. Well, that means just that one portion there is going to be taxed at 22, not the money before it. But when we do Roth conversions, we want to try to, sometimes someone's in a 22% bracket and we can convert enough that'll still keep them in the 22% bracket, or very little will they, tip into the 24. But that's exactly what retirement income plans and tax planning do alongside with your investment management. It's what I'm saying, the whole purpose of this digital seminar is to show you that you can't stick with the traditional things you always have in the past, because you're different now. And the world changes all the time. That's never going to be different. Change is constant. So those are the tax brackets and how they work. And I hope that might help give you, if you're a complete novice on taxes, to try to envision it that way. Now, what are advantages for Roth conversion? Well, people ask me all the time, and I tell them that you have no required minimum distributions. Required minimum distributions are something that you have to take starting now at age 72. Of course, this year, due to the pandemic, you don't have a forced withdrawal that you have to make no matter what age you are. But like I said, if you still need the income, of course, you're going to take the money out. The other thing is that, Rob, the whole reason that you even want to consider and sitting with a tax and retirement planning advisor would be to go and just kind of see how much you can do to build how much can you build your tax-free income, because they are tax-free as they grow, and they're tax-free no matter when you take it out, and there's no required withdrawals. And even if there were required withdrawals, there's no taxes on it. So you could take it from one pocket and put it just right into another pocket with no haircut, as they say, no skim. In all this tax planning and Roth conversions long-term for part of your money helps it last a lot longer, and it's going to be not subject to the 2026 tax freight train that I've been speaking of. So what a Roth conversion, what we call an IRA exit strategy, is the simplest way to explain it is you have that bucket on the left that says IRA. It could be one account, a whole account, a part of a regular IRA, part of a 401k that's been rolled over. You pay the tax once you know if there's an amount that you're going to do it, and you're sticking within a certain bracket, and you see that it's what it is. You're not making any mistakes. You pay the tax now. Now, sometimes, let me pause, in early years of retirement, until you have pensions kick in and stuff like that, if you have a lot of extra cash kind of laying around, and I don't mean to sound flippant, but some people do have a lot of cash laying around. And what you can do is, by living on some of that after-tax cash that you have, that won't get put onto your tax return. So you'll be able to keep your income low enough that sometimes we can do some conversions for people with no federal taxation, because we keep it under a certain bracket. Or they do less, they pay less overall if we go even above that. So what you do is you pay the tax on it now, and then that thing sits in the bucket for 5 years. And each year, starting in year one, 20% of it is automatically tax-free permanently. And a lot of people say, and I think it's a very wise question to ask, is that, are you worried about them changing the code? Well, yeah, they probably will change the code at some point, because there's no guarantee of it, so you have to assume that it can be. So, but the thing is that you would be grandfathered in. All of the big tax changes that have ever occurred in the book, and I am quite expert at it, have always been something where what was done before, if it was a taxable treatment before, everything that already is in place is okay. But going forward, there's going to be less advantages for people. So that's another reason why, he who hesitates is lost. That's one example. Sometimes it's good to hesitate. So just to explain for those of you who aren't familiar with RMDs, for those of you who are, please forgive me, I won't spend a ton of time anymore on this, but now you have to be 72 years old before you are forced to start to take a minimum and increasing amount of all of your qualified IRAs, all that stuff, for the rest of your life. And it will continue on to a spouse or to a beneficiary, to another person, a sibling, child, whatever. So how it's done is that every year you have to take it sometime during the tax year that you are age 72. And you take your full balances at the end of the prior year, and you divide it by a factor that's going to be different each year. The very first one is 27.4. That's how many years the IRS says that you have left. And that amount would be, in this case, 18,000. And so it is waived again this year, even if you are of age or not. But like I said, if you need the money, you take the money. So once again, that IRA exit strategy is that this bucket on the left is some part of an IRA or a total account. There's lots of rules, but this is what we routinely help people with. And you would pay the tax now if indeed it was taxable. I mean, most of you will pay taxes on it, so I'm not trying to mislead people. It's just in certain special situations or people with lower budgets that just do not spend a lot, they can do more Roth conversions and really set themselves up to be protected and keep more of their money when the tax stream hits in 2026. And then remember, you convert a part of IRA or a whole IRA into a Roth, and it is now going to be tax-free while it's growing. The lump sum's tax-free because you already paid the tax on it. So the lump's tax-free, and what it grows to be as it grows is tax-free. And when you harvest anything from it, take a withdrawal, it is tax-free. And to heirs, it is tax-free. Very, very valuable tool. Now I'm going to share a little bit of a story here very quickly. Put myself back on camera, and we're going to talk about this case that I have here, and I'll open it up in a second. This is an example of what I call the 800-pound tax gorilla, and what happens to people that are really, really good savers and live prudently. And it's not necessarily a reward. So take a look at this. I'm going to show you in a minute, but let me give you the situation. The couple's 5 years apart in age. One was 70 when they came in, and of course the other spouse was 65. 5-year difference. That person retired and had to start taking Social Security. Now this couple lives very modestly. They live on maybe $60,000, if that, and they could probably, as prudent as they are, they probably could stay that way for a long, long time. Most people are not quite that stable as far as those things go, but that's why they've also accumulated quite a bit. So they both had very large IRAs. You can see them up here where my mouse is. This is just their IRA portion. You know, they each had a very significant $1 million each of them. Okay, and people are going to say, "Oh, boo-hoo, what a problem to have." But, you know, when people have taken the time and sacrificed and really tried to do the right things like this, this is the most personal, one of the most personal things in their lives, and they don't want to be told what to do, especially when it comes to things that will diminish the life of their money. And that's the whole point of all of this once again. So as you can see on the right column here, the 83,000 was their income. Now, I told you they already only live on 60, so they're already pulling more out than they need to. And when I showed them this, and I showed them when both of their RMDs kick in, and this is only, look at the arrow up here, we were only using 3% in this example to be like a stress test. Really, they probably would have more of like a 5.5% return, which would make all of these numbers bigger and worse. So just remember that. So you see the column here where I have the mouse, and you can see that when they saw, in 6 years it's going to be, or 5 years it's going to be 118,000. That's going to be 165, 169, and if we earn more, it's going to be even greater. We don't like that. So that's forced taxation because of the RMDs. Now this was back when RMD age was 70 and a half. So what we did with them, this, what you see here, never happened. I'll pull myself off again here. What you see here on the far right column to the right of the arrow never happened, because what we did was we ended up converting $1 million over 5 to 6 years of it, so 500,000 in each of theirs. And what we ended up with is that they still have some traditional IRA, but they are not overloaded on it. And this scenario, or the worst one, never happened to them, because this was at the time when we were first just doing our analysis and showing them what their RMDs were going to be, because they were great savers. Now they had the right conditions and everything to do conversions, and we can't go into everything on that if I want to keep this at 25 minutes or so. So that's that. I want to finish up here with a case study. I had a client that came to me came to our firm a number of years ago, and he was an engineer, very intelligent fellow, and he had calculated, he was with someone else in a different tax preparing CPA before. And he told me this scenario. He said, in December 1st or roughly, I knew exactly what my taxes were going to be for the year. And then after in April, when we filed and all that stuff, okay, I saw that there was an anomaly here. And I says, what's the anomaly? And he says, well, is there such thing as a 50% tax bracket? I said, what are you talking about? He says, you know what? A little after I figured out my taxes for the year, I knew what income I was going to get. You know, I had factored that all in for the rest of December. But then Dolores and I decided to take an extra $1,000 out before the end of December. And I go, okay, so what's the problem? He says, the problem is that I thought it would only cost me $120 of extra tax because I'm on a 12% bracket. But it ended up, they ended up taking 50%. I mean, it ended up costing me in levies 50%. He says, Jeff, is there a 50% tax bracket? And I says, no, there never really has been. And I think there may have been like 50 years ago, but I mean, that's ancient history. Okay. So I went through his scenario and I decided that to walk him through it. So I will walk all of you through it. All right. So I call this collateral damage or unintended friendly fire on your other assets. It's really like when you take with IRA withdrawals unbeknownst to you, and they end up making you pay more taxes on some of your other income that was not taxable before. So here's what his scenario was. Him and his wife were over 71. They had Social Security of $60,000. They had $15,000 of net long-term capital gains, which is taxed in a whole different subsystem, as well as Social Security has MAGI, modified adjusted gross income. So Social Security has its own system, subsystem. Long-term capital gains has its own subsystem. And then your R&Ds or any IRA withdrawals, anything not Roths, but any regular IRAs or beneficiary IRAs are essentially taxed as ordinary income, which is another subcategory. So would you ever really be able to just eyeball those numbers and know what you would pay if you took out more money in a given year? Jeff, is there a 50% tax bracket? How in the world did that happen? Well, this is what he thought would happen, and he wasn't wrong. However, this triggered some collateral damage. So now his IRA started to shoot his taxable Social Security, which brought in another $850 that wasn't taxable before. So now it cost him $102 with this move, simple move. And then it also brought in the other subcategory, $1,850 more of capital gains that became taxable. And those had their own, as you can see, it's a different bracket. It's at 15. Different subsystem, and that was the largest levy of the three. So you add them all up, and it's 50 cents short of $500 on a $1,000 withdrawal. So I guess effectively there can be a 50% bracket, but there's no official one. So what I'm going to do one more thing before we wrap up is I want to show you how we prove this out, because you know anybody could put anything on a board, and I'm going to show you something where it cannot be even faked. Okay, I have one image up here, and I'm going to put up another one in a second. The bottom line is that this has all of those items that I just went through with you, but it's in what's called our tax planning, which is one of the things we use to deal with people's financial plans and do their tax planning, of course. So this is how the rubber hits the road. This is the short version of it, but it has it all. Okay, we have all of these things listed here. On the income on the left side, the gross income came to 120, but of 120, only 105.1 of that was brought on the taxable side because of how the system works. You can't eyeball it, and you can't intuitively figure it out. You have to put it through a calculator. But here's the bottom line to focus is the very, very bottom number here, 8139. That was their effective federal tax after their deductions and everything else, and capital gains consideration. But that doesn't mean anything until you see the other number. So I'm going to put the other image up now. The other image now shows that they went from 8139 to 8639. That is $500, literally almost to the penny. That is the difference. Now, if you look, the only difference of the image on the right, where I have this big thing that says with extra $1,000, this is that $1,000. It could have been combined with this one because these are both taxed the same. These are different, and that's different. There's many others too, but this is just an example, a real life scenario. And so essentially, you see how it brought in the collateral damage is that before 45,100 was only taxable of their Social Security with their other items. Now there's that $850 difference right out of their pocket for doing barely anything. So my question for everyone here is, what would have happened if they took out 10,000? So the point is that retirement does not have to be, you do not have to guess through retirement. There are qualified professionals, very specialized, that combine long-term asset management with lean expenses and with annual and going forward pro forma tax planning. You can do it if you deal with a true fiduciary, but they're not all structured the same. So be very, very careful as to who you deal with. But I can tell you that it is not only important to have the plan that is a living, breathing thing, so you always know where your money's coming from and why, and have it explained in human terms that you can understand. It's also the only way that you could truly do efficient tax planning that we're seeing here. So these are all things, having a plan and all the things in it are really all about, and I could put it in one summary, making your money last as long as possible, not flittering it away on lack of knowledge or, oh, I just don't really care, or my guy doesn't do that, he's more just a broker. That's the kind of thing. So I'm going to give you a closeout here. When I had a friend of mine who went on a vacation into Grand Canyon with his wife and his two boys, and they were going to one destination that was about 40 miles away. It was their last destination for the day, and they only had, and they couldn't get gas until they got there. So he told me that they had about 1/8 of a tank when they started, and they didn't want to wake up the boys. They were finally asleep and not driving the parents crazy. But they decided, the husband decided, no, I don't want to get gas. The wife says, yes, we should get gas. No, the husband says, we can do, let's just go. I don't want to wake up the boys, and I think we can make it. He had to have a little fun with it, I guess. It's probably something I would do. Maybe that's why we're friends. But anyway, to make a long story short, too late, is that, as they were driving closer and closer and closer, they started to look around and get really fixated on the gas gauge. And because now the gas gauge was almost at the complete bottom, and they still had about 10, 12 miles to go. So they were starting to really focus on that. And then the boys woke up after a while, and they wanted to get to see what mom and dad are looking at. So they started looking at the gas gauge. Well, the moral of the story is, by the time they got there, they did get there without having to walk. But they realized that they missed all of the sights, the whole reason why they were there, and that the ride back is going to have a different perspective than the way there. They missed it completely. And why? Because they focused on the wrong thing. They focused on the gas gauge. They focused on the CNBC every day. What does this do? What does that do? You don't need that for retirement. It's not a key to happiness. Yet so many still allow themselves to be trapped in that cycle of suffering. You don't need that, especially when you have a financial plan. So like I said in the beginning, we do process before product or portfolio recommendations, but we always complete a plan for everyone that shows, or a plan doesn't mean we take control of you. A plan means you get to take control of you, because you now have everything up there, and you have a couple of qualified professionals, because we always do 2 advisor appointments, and you have the attention of 2 qualified people also that sit there, and you're the most important person in the room when we're there, and that's important to know. But in these pandemic times and stuff like that, we're doing a lot of this virtual in the meantime until we can do our live meetings and people can relax more. We understand. So there's going to be a link here that you're going to be able to just click on. And if you want to, I'm going to make available to you a 15-minute phone consultation. And I call it like a pre-planning consultation, because it's going to try to be like what we do in person for the first appointments, is You don't bring anything with you. We don't need to get in a bunch of specifics. We really want to just start to see if we each are a good fit for each other and that we can benefit you. If so, we'll be able to explain to you our entire process. We'll email it all out to you, and you'll be able to proceed with virtual meetings if you would like, or whatever. But you can only sit and hesitate so long about the very things that are going to support you the rest of your life. So I want to see if there's anything else. Oh, yes, if you do click on and for your 15-minute consultation, how could I forget? You're going to get a free copy sent to you of my Retirement 2020. I told you I wrote several books. This is my most recent one. It's a nice, thin, concise paperback, but it helps people orient themselves to pre and post-retirement issues that you never had to before. So we have lots of stuff for reading for those of you that like to do that, and some people don't, and it is okay, whatever. So thank you very much for listening. I greatly, greatly appreciate your attention so much. And I do hope we get a chance to engage with you and to help you have a carefree retirement as best as possible. Thanks so much.